Okay, you are thinking about owning a bank. From the outside, it can look like the cleanest business imaginable. Customers provide the money, borrowers pay interest to use it, and the owner keeps the difference. But a bank is not a vault that happens to make loans. It is a highly leveraged balance sheet that must remain profitable, liquid, compliant, and trusted every hour of every day. This breakdown will show what ownership actually requires, how a bank earns revenue, where the money disappears, and why a bank can look healthy on paper while moving dangerously close to failure. Start with the product. A supermarket sells groceries. A trucking company sells transportation. A bank sells access to money across time. Depositors want safety, convenience, payments, and the ability to withdraw. Borrowers want purchasing power today in exchange for repayment tomorrow. The bank stands between them. It gathers funds from depositors and other sources, then places those funds into loans, securities, cash, and other assets. The bank earns income when those assets produce more than the bank pays for its funding and operations. That sounds simple until you look at the accounting. A customer deposit is cash to the customer, but it is a liability to the bank because the bank owes it back. A mortgage is debt to the homeowner, but it is an asset to the bank because the homeowner owes the bank. This reversal matters. The bank's building, logo, app, and branches may be visible, but the real business is a constantly changing collection of promises. Some promises may last overnight. Others may last 30 years. Ownership depends on managing those different promises without losing control of the timing. With a bank, 3 resources determine survival. The first is capital, meaning money belonging to the institution and its shareholders. The second is liquidity, meaning cash or assets that can quickly become cash. The third is confidence, meaning customers and markets believe the bank can meet its obligations. A bank may have valuable assets and still fail if it cannot produce cash quickly enough. It may have cash and still become unsafe if losses consume its capital. And it may satisfy yesterday's numbers, but face a run today if confidence disappears. This is the kind of ownership math we examine here. Not only what a business earns, but what it must survive. The old explanation of fractional reserve banking often begins with a fixed reserve percentage and a neat multiplication example. Modern American banking is more complicated. In March 2020, the Federal Reserve reduced reserve requirement ratios to 0. That did not eliminate the need for liquidity, and it did not allow banks to lend without limits. Banks remain constrained by capital rules, liquidity expectations, supervisory standards, internal risk limits, market conditions, and the basic need to meet withdrawals and payments. The important ownership lesson is not that a bank lends a mechanical percentage of each deposit. It is that the institution transforms short-term funding into longer-term assets while trying to keep enough resilience for unexpected demands. Either the entry barrier. You cannot rent a storefront, install a secure door, call the business a bank, and begin accepting insured deposits. Organizers seeking a national bank charter apply to the Office of the Comptroller of the Currency. A state-chartered institution works through its state authority. An institution seeking federal deposit insurance must also satisfy the Federal Deposit Insurance Corporation. Regulators examine the proposed market, business plan, management, ownership, capital, risk controls, projected financial statements, and the background of the organizers. Approval is not a purchase receipt. It is a judgment that the proposed institution has a reasonable path to operating safely. The amount of startup capital is not a universal number. It depends on the charter, strategy, market, growth plan, risk profile, and supervisory assessment. Regulatory minimum ratios also should not be confused with the practical capital expected from a new bank. Federal rules include minimum ratios for common equity Tier 1 capital, Tier 1 capital, total capital, and leverage, while supervisors can require capital commensurate with an institution's particular risks. In plain language, arriving with the technical minimum is not the same as arriving with enough money to earn approval, absorb early losses, fund growth, and reassure depositors. Is also different from working cash. Organizers may need to fund legal work, consultants, application preparation, executives, technology contracts, cybersecurity, office space, vendor due diligence, insurance, and staff training before meaningful revenue arrives. Then the bank must preserve enough capital after opening. A dollar spent launching the institution no longer sits in the capital cushion. This creates a difficult tension. The bank needs infrastructure to operate, But every early expense reduces the resources available to absorb future losses. The ownership route matters. Building a new bank gives organizers control over culture, technology, market focus, and underwriting standards. But it also means starting without an established deposit base or loan book. Buying an existing bank may provide customers, employees, systems, and regulatory history. But the buyer inherits old loans, contracts, operating habits, and potential problems. A low purchase price may signal weak earnings, poor asset quality, expensive technology needs, or a concentrated customer base. In banking, acquiring history can be useful, but history can also contain losses that have not fully appeared yet. Once open, the institution begins paying for a workforce that customers may rarely notice. Tellers and branch managers are only the front layer. Behind them are lenders, underwriters, credit analysts, deposit operations teams, treasury staff, accountants, internal auditors, compliance specialists, fraud investigators, cybersecurity professionals, information technology employees, model risk personnel, and senior executives. Smaller institutions may combine roles, but they cannot combine away the responsibilities. A bank that saves money by weakening control functions may report lower expenses temporarily, while accumulating a much larger future problem. Technology is not optional decoration. The core banking platform must keep accurate account records. Payment systems must move money. Mobile and online services must remain available. Fraud tools must identify suspicious behavior without blocking every legitimate customer. Customer information must be protected. Vendors must be monitored. Systems need backups, access controls, incident plans, patches, testing, and recovery procedures. A neighborhood bank may compete locally, but its customers compare the app with products offered by national institutions. That means even a small bank carries expectations created by some of the largest technology budgets in the financial world. Compliance creates another permanent cost center. Banks operate under rules covering safety and soundness, consumer protection, fair lending, privacy, anti-money laundering controls, sanctions, reporting, disclosures, and deposit insurance. The precise obligations depend on the institution and its activities, but the economic pattern is consistent. Compliance work does not disappear during a slow sales month. Examinations, monitoring, documentation, training, audits, and remediation continue. A bank can increase revenue by entering a new product line, but the product may also create new systems, staff, legal review, and reporting obligations. Then comes the cost that every lender eventually faces: borrowers who do not pay as promised. A bank prices credit partly according to risk, but a higher interest rate does not erase the possibility of loss. If a borrower defaults, collateral may be worth less than expected. Legal recovery may take time, and the bank may receive only part of the balance. Banks therefore recognize expected credit losses through allowances and provisions. During stable periods, credit costs may look manageable. During a recession, losses can rise while new lending opportunities weaken, creating pressure on both income and capital. The main revenue engine is net interest income. The bank earns interest on loans and securities, then subtracts interest paid on deposits and other funding. Analysts often compare that result with earning assets through the net interest margin. The number is useful, but it is not the owner's final margin. Payroll, technology, premises, professional services, marketing, insurance, deposit insurance assessments, fraud losses, compliance, and credit provisions still have to be paid. A bank can report a healthy spread and still produce disappointing net income if overhead or losses are too high. Funding quality matters as much as loan pricing. Some customers keep stable operating balances because they use the bank for payroll, bill payment, merchant services, or treasury management. Other deposits move quickly when another institution offers a better rate. Large uninsured balances can be especially sensitive because the standard federal insurance limit is generally $250,000 per depositor, per insured bank, per ownership category. A bank that attracts deposits mainly by paying the highest available rate may grow quickly, but that funding can become expensive or leave when conditions change. So earn non-interest income. Depending on the model, that can include account services, payment processing, card interchange, wire transfers, mortgage origination, loan servicing, trust services, wealth management, treasury services, foreign exchange, and advisory work. These streams can diversify revenue, but each has costs and risks. Fee income may require specialized employees and technology. Certain consumer fees can bring regulatory and reputational pressure. Wealth management may produce recurring revenue, but it depends on client assets and trust. Investment banking can generate large fees, but it belongs mainly to a different scale of institution than a new community bank. Scale changes the economics. A large bank can spread cybersecurity systems, legal teams, data platforms, and marketing across millions of customers and multiple businesses. It can collect revenue from consumer banking, commercial lending, payments, asset management, markets, and advisory services. JP Morgan Chase reported $57 billion of net income for 2025. But that result came from a global firm with enormous assets, multiple business lines, and decades of infrastructure. It is not evidence that one local bank can reproduce the same profitability. Corporate results and individual location economics must remain separate. IDBank may have a different advantage: relationships. Local knowledge can improve service and help lenders understand businesses that do not fit standardized national models. A banker may know the customer, the industry, the property, and the local economy. But concentration is the price of that familiarity. If too much of the loan book depends on one town, one employer, one property type, or one industry, a local downturn can damage many borrowers at once. The bank may understand every loan individually and still be exposed to the same underlying risk across the entire portfolio. Elena and her investor group are evaluating a simplified community bank model. This is an educational illustration, not an industry forecast. They plan to contribute $20 million of initial equity. After organization and opening costs, the bank begins with $18 million of usable equity. Over time, it builds $200 million of average earning assets funded by deposits, equity, and other liabilities. If the average yield on earning assets is 6%, annual interest income would be $12 million. If average interest-bearing funding costs 3% on $150 million, interest expense would be $4.5 million. That leaves $7.5 million of net interest income before operating costs and credit provisions. Now add $2 million of non-interest revenue. Total revenue before provisions becomes $9.5 million. Suppose salaries and benefits cost $4 million. Technology and vendors cost $1.2 million. Premises and administration cost $800,000. Professional and compliance costs $700,000. Marketing and other expenses cost $400,000. And the credit loss provision is $600,000. The model produces $1.8 million before taxes. That is a respectable accounting profit, but it is only 9% of the opening $20 million investment before considering taxes, dividends, future capital needs, and the value of the investor's time. The model becomes more revealing when conditions change. If deposit competition raises annual funding costs by 1 percentage point on the same interest-bearing balance, interest expense rises by $1.5 million. With everything else unchanged, pre-tax profit falls from $1.8 million to $300,000. If credit deterioration then requires an additional $1 million of provisions, the bank moves to a $700,000 pre-tax loss. The customers may still see a polished branch and a functioning app. Loans may still be paying, but the owner's economics have changed because two pressures attack the thin residual left after fixed costs. This is why interest rate risk deserves special attention. Bank assets and liabilities reprice at different speeds. A variable rate business loan may adjust quickly. A long fixed rate mortgage or bond may remain locked for years. Depositors, however, can demand higher rates or transfer money rapidly. If funding becomes expensive while asset yields remain fixed, the margin narrows. If market rates rise, older fixed rate securities may also fall in value. The loss may remain unrealized while the bank holds the asset, but it becomes economically important if the bank must sell to raise cash. Silicon Valley Bank demonstrated how quickly that combination can become fatal. The bank had grown rapidly alongside the technology and venture capital sector. It invested a significant amount of incoming deposits in longer duration securities. When interest rates rose, the market value of those securities declined. At the same time, technology clients were spending cash and withdrawing deposits. On March 8, 2023, the company announced a balance sheet. Restructuring that included the sale of roughly $21 billion of available-for-sale securities at an after-tax loss of about $1 $0.8 billion and a planned capital raise. Uncement intensified fear rather than restoring confidence. By the end of March 9th, about $42 billion in deposits had left the bank. Regulators closed it the next day. The Federal Reserve's later review concluded that management failed to manage risks. The board failed to provide effective oversight. Supervisors did not fully appreciate the vulnerabilities as the institution grew, and corrective action was too slow. The lesson is broader than one management team. Safe assets can create dangerous liquidity problems when their maturity, market value, and funding source do not fit together. ISK can arrive more slowly but become equally destructive. A bank specializing in commercial property may look diversified because it has hundreds of borrowers. Yet, if many loans depend on the same office market, rental trend, or refinancing environment, the portfolio may behave like one large bet. The same applies to agriculture, energy, construction, hospitality, or technology. Diversification is not merely counting loans. It means understanding whether different borrowers will fail for different reasons, or whether one economic shock can weaken them all at once. Liquidity. Risk asks whether the bank can meet withdrawals and payments. Today, without selling assets at damaging prices. Capital answers whether the institution can absorb losses. Liquidity answers whether it can survive the timing. A solvent bank can face a crisis if too much cash leaves before assets mature. That is why banks hold cash, central bank balances, marketable securities, borrowing capacity, and contingency plans. But every low-yield liquid asset may reduce current earnings. Owners are constantly balancing resilience against return. Operational risk can break the model without a recession or rate shock. A cyber attack can interrupt payments. A fraud scheme can create direct losses. A faulty model can misprice thousands of loans. A vendor outage can disable customer access. Weak controls can lead to enforcement actions, remediation expenses, or restrictions on growth. Even reputational damage has a balance sheet effect, because banking customers are not only buyers. They're also funding providers. When customers lose confidence, the bank can lose both revenue and liquidity. Deposit insurance reduces the incentive for insured customers to run. But it does not make every balance fully insured or every bank immune from panic. The standard limit applies by depositor, bank, and ownership category, so account structure matters. Commercial customers, institutions, and wealthy households may hold balances above insured limits. A bank with a large share of uninsured, concentrated, and highly connected depositors may face faster withdrawals than a bank with many smaller retail accounts. Digital banking has compressed the physical act of standing in line into a few taps on a screen. Ownership also involves limits on how freely profits can be removed. A manufacturing owner may decide to distribute excess cash after paying bills. A bank's board must consider capital ratios, growth, expected losses, liquidity, supervisory expectations, and restrictions that can apply when buffers weaken. Reported net income is not automatically available for dividends. Fast loan growth may require retained earnings or new capital. The owner can be profitable on paper while choosing, or being required, to leave much of that profit inside the institution. Expansion adds another trade-off. New branches can attract deposits and relationships, but they add leases, employees, security, equipment, and local marketing. Digital expansion avoids some property costs, yet increases technology, customer acquisition, fraud, and support expenses. Acquiring another bank may create scale, but systems must be converted, cultures combined, customers retained, and loan books reviewed. Growth can improve efficiency only when controls, capital, funding, and management capacity grow with it. Otherwise, growth magnifies weakness. The resale value of a bank is not simply the value of its building plus cash. Buyers examine tangible book value, earnings power, deposit quality, credit performance, market position, technology, management, compliance history, and the risk hidden inside assets and liabilities. A valuable low-cost deposit franchise may attract a premium. A bank with expensive funding, weak controls, concentrated loans, or large unrealized losses may sell below the value owners expected. Even then, regulatory approval and transaction structure can determine whether a deal closes. Owning a bank can absolutely be profitable. The industry exists because maturity transformation, payments, lending, and financial services create real economic value. A disciplined bank can build durable customer relationships, recurring revenue, and a valuable franchise. But high revenue is not owner income. Deposits are not capital, and accounting profit is not the same as immediately distributable cash. The owner is being paid for managing credit, rates, liquidity, technology, compliance, operations, and confidence at the same time. The most important number is not the interest rate printed on a loan. It is the amount left after funding costs, operating expenses, expected losses, taxes, and capital needs. The most important asset is not the marble branch or the mobile app. It is a portfolio that performs under stress. And the most dangerous assumption is that stability will continue because it existed yesterday. Banks often fail at the intersection of risks. Concentrated customers withdraw, assets lose value, funding becomes expensive, losses reduce capital, and confidence accelerates the process. Owning a bank means owning a system of promises. Depositors expect access. Borrowers expect funding. Regulators expect resilience. Employees expect systems that work. Shareholders expect returns. Those promises can create a powerful business when the balance sheet is conservative, the funding is dependable, and the controls are strong. But the same business can unravel quickly when assets, liabilities, and confidence move in different directions. The real opportunity is not collecting effortless interest. It is building an institution trusted enough to receive other people's money and disciplined enough to return it when they ask.